Hello, everybody. Welcome to an episode of Money Matters. I am your host, Huong with Cash Property, and we are going to get into a really interesting topic about turning bad debts, however you want. Hopefully, you only have one or two of them, bad debts into good debts. And this is really timely because we're in December. And what happens in December? Well, a lot of overspending because of the Christmas holidays, a lot of wine drinking, a lot of gifts, a lot of traveling, a lot of overspending. And it's amazing how people overspend during the Christmas times. Okay, so welcome, my friends. I hope you get a lot out of today's episode because my goal is to really help you find the financial freedom and be great with your money so that you can have more time with your family and live the life that you really want. So let's get right into it. So, being from a real estate background and, being from an analytical engineering background, I'm always looking at different ways to make my money work more for me. Okay. And the thing is that if you have bad debt, it is very, very hard to get that financial independence, to build that wealth, because bad debt doesn't put money back into your pocket. Like it's money that goes out and it's not making money for you. So it's not following the golden egg or the golden goose mindset that I've been trying to, pass along on these episodes. That reminds me, if you are watching this and if you have not given me a like or a thumbs up or subscribe, please do that. That gives me the feedback that I know to keep going with these episodes. And if you want better content, okay, I need a little bit of motivation. Okay, so and I'm going to relate this bad debt, good debt stuff back to the condo idea. So if you are a real estate investor, you know that the condo strategy is it's not the best one out there. Like, yes, you can be an investor and yes, you can buy condos and do passive investing on that, passive income and all that stuff. But at the end of the day, the condo strategy is not really the best one. Okay. And I don't have enough time within like 15 minutes to explain why condo strategy is just not the best one. But here's how you can turn a condo strategy, which is sort of in my mind like a bad debt strategy, into a better good debt strategy. Okay, so so the condo is one area. The other one is around Christmas gifts. Okay, and then I'm going to talk a little bit about the trips because during Christmas time we do overbuy on a lot of gifts. So how do you turn gifts, which is sort of bad debt because we put it on our credit cards, we pay it off, and it doesn't generate any stuff for us, right? Like, so it classifies as bad debt. So how do we turn stuff like that into good debt? So I'm going to actually show you how to do that. Okay, so I'm going to show you with the condo, but with the gifts and the trips, I'm just going to talk about that as opposed to doing a calculation because you really don't need to do a calculation on that. Okay, so here's the idea. During Christmas time, we're buying a ton of gifts out for family and people and all that stuff. So here's a way to turn the gifts into something that is cash generating, passive income, all that stuff. Okay, so one is with the gifts is rather than just buying a physical toy or a gift for somebody, one is either gifting a stock certificate. Okay, so physically buying, say, a McDonald's stock. So I've done that for some kids that I know, like I'll physically buy a stock for them. Okay, or if you can, invest in something like a stock. So then that way you're physically giving them a stock and you give them a smaller, like candy or toy or something. But the bigger gift is really the stock stuff. And the stock can be like $50. Okay, it doesn't need to be a big item stock. So, and does one stock really do anything? It doesn't do anything right now, but you think about it, the kids, 10, 12, maybe 7 years old, they hold onto that stock. You don't need to monitor it. You don't need to do anything with it. When they're like 25, they can cash that stock out if they want. But the bigger gift, besides, the compounding interest on that stock, is that now they have this piece of paper and they're like, what the hell is this stock? And then they start learning about the stock. That learning gift, like, it's absolutely priceless because now they're like, well, wait a minute, I've already got one. Why don't I just buy two? Why don't I ask for my future gifts from other people to compound this stock, like to grow this particular stock so that I don't just have one, I have two or three, maybe four. Okay. So that's one idea around the gifts. The other thing that you could do around the Christmas gift giving is rather than buying somebody a gift, is that you invest in their company. So there's a person that I know that is doing like a baking company and they're just starting off. And so rather than buying the family a gift, I just invested money in their company. Okay. So the great thing about that is now I invested in their company. I'm helping people financially, but also too, I'm also getting some baked goods out of it. Okay. So there's a trade-off there. Okay. The other one is around traveling and trips. During this time, like we're getting ready to travel as well, and a lot of people travel throughout the course of the year. So how do you turn the traveling, which is bad debt, because you buy flights, you spend money on hotels, food while you're traveling, souvenirs, all of that is bad debt. Yes, you do convert that to emotional, gratification and you memories and all that stuff. Yeah, yes, you get all that stuff, but it's still bad debt at the end of the day. Okay. So how do you turn that bad debt into good debt? Okay, so when it comes to trips, the way to turn that into a good debt is you tie it into researching business or real estate. So for example, we're getting ready to go to Japan. Okay, so while we're in Japan, like for the last year, I've been researching resorts and real estate in Japan. So now that we're going to actually physically go to Japan, it's like, well, wait a minute. Let's go and actually look at some real estate while we're there. Let's go and see if there's a conference. Let's go see if there's some networking events. Let's actually go and meet some of the people that we've spoken to by email while we're physically there. Okay. And so by doing that, now I've taken a family holiday and yes, I'm adding work into it. Okay. But it's work that I love to do. And so now while we're actually in Japan, we're going to actually, have some meals and all that stuff and go to Disneyland or whatever. But we're also able to write off a major portion of our trip. Okay. So that's how you can turn a family vacation into a family vacation, which I label as bad debt. Okay, you can turn that into good debt. Okay, and that's how you do that by making it into a business venture. Because at some point, I am going to buy something in Japan. At some point, I am going to do a business investment in Japan. Okay. Okay, so let's get into this condo idea. So, this is the third one about how you can take good debt and turn it into, sorry, a bad debt, which is a condo purchase, and turn it into a good debt. So, like I mentioned, condos is one of the worst real estate strategies there are because it doesn't usually cash flow if you hold it long term. And, pre-sale condos, sometimes they work, sometimes they don't. Like it's a hit and miss. And right now, pre-sale condos is a massive disaster. Okay. And then on top of that, if you purchased a condo thinking, hey, you know what, I can Airbnb it and it'll turn off, like it'll cash flow, blah, blah, blah. Depending on what city you're in, you can't even like Airbnb it now. Okay, so that condo idea is not ideal. Okay, so now if you are in a condo strategy, if you want to get into condos, the condo strategy can work if you use it as an entry level strategy. If you use it for like getting in and building up, it's called a ladder strategy, like the steps in a ladder. Okay, that is how you can turn a bad debt condo into a good debt condo. So the way to do it is, okay, I'm actually going to bring up a spreadsheet here because this is one of the ways to look at it. So let me explain why this condo thing just doesn't make sense. Okay. So, and I've put in some general numbers here just to give you an idea here. So, if the purchase price of a condo is like half a million. Okay. And yes, you can still buy condos for half a million, like in Toronto, yes. So you're buying like maybe one bedroom, super small, two bedrooms. Okay. Toronto, Vancouver, you can still get condos around that price range. Okay. The rents that you're looking at is maybe 2,500. Okay. Average, give or take. Okay. I've thrown in a 300 maintenance fee here. That's per month per unit. This is one of the reasons why condos do not cash flow because this maintenance fee never goes down. Okay. I've heard of some cases where they do go down, but on average, never, never, never do they go down. They always go up. Always. Okay. And then you throw on the special assessments. Psh, okay. Like you never will cash flow with a condo. Okay. So now I've thrown in some other expenses. Okay. And I've thrown in 30%. So the others around 750. Okay. And the 30 is just a number I picked out of the sky. And could it be less? Could it be more? Yes. Okay. So the way to calculate this other now is you just take your 30%, so whatever percentage you want, times your rent. And this is per month. So that means I'm paying an extra 750 in fees. So this would cover property taxes. The maintenance fee is separate. That's the 300. I would still have insurance, painting, legals, accounting, all of that stuff would be a part of there. If there's something inside that condo, it's up to me to fix that as the landlord. Okay. The NOI before expenses, so before the mortgage, is going to be about 1,400. You look at that. Just from that alone should give you the heads up. Okay, I'm going to make $1,000 a month. Okay. If you stop your calculation there and you say, hey, I'm going to make $1,000 a month, you're doing yourself a massive disservice. Okay. Because you are going to have a mortgage. Like this mortgage, look at this, it's already more than what you're making in the rents minus your expenses. That's why condos don't cash flow if you have a long-term tenant in there. Okay, so if you can do midterm rentals, that's a different strategy and maybe that might work. Okay, so keep in mind that this is assuming that you have a long-term tenant in there. And if you're in BC or in Ontario, we're under rent control. Okay, now if you're in Ontario, if it was built after 2018, then you're not under rent control. So that's slightly a different modification consideration. Okay, so now the other thing that I've done here, okay, so now this cash flow, look at this number here in the red, okay, $200 to $600, depending on what your down payment is, depending on a bunch of scenarios. But usually you are negative cash flowing on a condo. If you can be neutral, like if you just break even on a condo, that's still not ideal. But at least you're not paying out of pocket every month, and it's sort of like a forced savings account. That's why condos are good as an entry level to say, hey, you know what? I'm in the real estate market. I am going to be saving, taking advantage of some appreciation, having some mortgage pay down. That's the forced appreciation, the forced savings account there. But otherwise, condos are not a good strategy as an investment for passive income. Okay, so now if you're looking at this and you're like, how come one is at a 5% down payment and the other two are at 20%? So I'm assuming that you're going to buy your first condo or at least one of the condos as your primary, be able to utilize the 5% down payment because it's your primary, live there for a year or two, move out, okay, and then rent that out. Okay. And then during that time frame, you're going to get two other condos. And because you already live in one as a primary, you can't say, hey, you know what, this new one that I'm buying is my primary, so I just want to put 5% in. So then with these later ones, you have to pay 20% down payment. Okay, so let's just say you get your down payments in. So that is going to affect your mortgage, which is why this mortgage payment for each of the condo is different from 1,600 to 2,000 something. Okay. Now, this is based on a 3% rate, if you're lucky to get 3% in today's environment, 30-year amortization, and assuming a 20% here. So I've done the calculation based on 5 or 20%. Okay. And the math around what is the mortgage payment is just an Excel formula, the PMT formula. So if you don't know that, you can watch one of my other videos, or just Google what the PMT formula is in Excel and just make sure you put a negative or positive symbol in front. Okay. And that will get you your mortgage payment. So once you know what your mortgage is, then you could calculate your cash flow. Okay. So that's fine. So now let's say that you hold on to these condos and then you eventually sell them down the road, okay? Condos, unless you're going to live in there, unless it's an emotional tie, condos at some point you should think about getting rid of them and upselling. Okay. This is how you can turn a bad debt condo into a good debt condo or a good debt strategy is you want to sell the condo and upsell. Take the profits that you've made, the gains that you've made, buy into a bigger house. Okay, a single family, duplex, a triplex, multifamily. You want to take those condos, eventually exit out of the condos and move into a multifamily. Okay, or a single family, and then eventually sell that and move into a duplex, triplex scenario. Okay, so you're going to take these condos and you're going to sell them at some point, take the profits and upsell. That is the ladder strategy. You want to take the bad debts and eventually roll them over, go up the rungs of a ladder and get into the good debt. Okay, so that is how you can turn bad debts into good debts. Okay, now, if anything that I'm saying is still questionable, please put a comment in, ask me the questions in the chat. I love getting the feedbacks in there. Okay. So the idea around here is that one, the condo market has to be going up. Okay. And the normal trend is over time, yes, they do go up. But if you buy a condo and then you try to sell it in a down market, like what we're doing, like what we're seeing right now, you're not going to see the gains. Okay. So you definitely don't want to be forced to sell in a down market. So you want the ability to hold on to your stuff until the market is going up. Okay. So having said that, if you didn't clue in on that, now is the time to buy condos. Okay, yes, you heard me right. Okay, now is a good time to buy. Now, will the condo market keep going down? Yeah, it could keep going down for a little bit, but if you're start looking at buying condos now, get in the position, get your finances in order to buy a couple of condos. Because here's the thing, if you can buy a couple of condos between now and let's say the next year or two, and you've got a couple of these condos and you're sort of break even, neutral, not this negative cash flowing situation that we're talking about here. You need to be neutral. Okay. Hold on to them. And then at some point in the future, as the market's going up, that's when you sell. Okay. If you can sell on that uptrend, so let's just say now you buy these condos, you've got now a value of 1.5 million. Like you see how quickly they stack up. Okay, and this is just with 3 examples here. So you buy 3 condos, 500,000 each, you're at now a value of 1.5. The down payment that you've put in is $225,000. And now like you've literally taken your personal net worth statement. Okay, significant. Like you've just grown your net worth here. Okay, so let's just do that math here. So you've put in 225 and we're going to divide that by 1.5. Okay, look at that. That's 15%. You've put in 15%. The bank has given you 85%. Okay, you're leveraging the bank by 85%. That's massive. Only in real estate are you able to leverage like this. Okay, unless you go into margins and stocks and stuff, that's a completely different strategy. Okay, now I've raised my own hand. Okay, awesome. Okay, so real estate is one of the ways where you can leverage. And look at this, like you're leveraging 15%. That's it. Okay, and at some point when you sell, assuming that you sell at these numbers here, you're going to sell at 2 million. You're going to make $500,000. Okay, to go from 225 to 500,000, you've doubled your money. Like you've actually more than doubled your money. Okay. So if you do this, quick math, if you do this over, let's say 4 years, if you can achieve this in 4 years, you've made 25% on your money. Okay. Now this is assuming that your cash flow is neutral. Okay. But if you put down 225,000 and you're able to sell all the units and gain 500,000 in 4 years, you've made 25% on your money already. That's a lot. Okay. So that is how you can turn good debt into bad debt. Okay, so that is what I have for you guys today. Thank you, my friends, for tuning in to another episode of Money Matters. I am your host, Hung Lu, and enjoy the rest of the week. Bye, everybody.